Today is Monday, 19th of May 2025 Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. The financial markets commenced the week on a note of mixed momentum, with the technology sector spearheading gains amid a backdrop of cautious investor sentiment driven by global uncertainties. Major equity indices registered an overall optimistic tone, bolstered by a robust performance in tech stocks, which continue to attract investor interest due to their resilience and growth potential despite prevailing economic challenges. The tech sector's persistence as a market leader underscores the ongoing transformation in both consumer and business landscapes, where digitalization and innovation remain critical drivers. Investors seem to be capitalizing on the strong earnings reports and forward guidance provided by tech giants, which have exhibited impressive adaptability and strategic foresight in navigating supply chain disruptions and geopolitical tensions. In contrast, the broader market sentiment is tempered by persistent global uncertainties. Concerns surrounding geopolitical dynamics, particularly in key regions prone to conflict, have kept investors on edge. These factors have the potential to impact global trade flows and economic stability, influencing risk appetite and investment decisions across various asset classes. Commodities and currencies have also been influenced by these broader geopolitical factors. Commodity markets are reacting to potential disruptions in supply chains, with energy and agricultural products seeing price adjustments in anticipation of fluctuating demand and supply scenarios. Meanwhile, currency markets are experiencing volatility as investors weigh the implications of geopolitical developments on currency valuations, leading to strategic repositioning in foreign exchange portfolios. As the week progresses, market participants will likely continue to monitor global headlines closely, assessing their implications for economic growth and market stability. The interplay between technological advances and geopolitical shifts will remain a focal point for investors, shaping the investment landscape and guiding strategic decision-making processes. The performance of major global indices reflects a diverse array of economic sentiments and market dynamics. In the US, the indices exhibited overall positive trends. The S&P 500 gained 0.70%, indicating a robust performance in the broader market, buoyed by gains in sectors like technology and consumer discretionary. The Nasdaq Composite saw a more moderate rise of 0.52%, suggesting that tech stocks maintained some momentum despite potential concerns over valuations. Meanwhile, the Dow Jones Industrial Average outpaced its peers with a 0.78% increase, possibly driven by strong performances in industrial and healthcare stocks. The Russell 2000, a key barometer for small-cap companies, surged by 0.88%, reflecting investor confidence in domestic growth prospects and the potential for higher returns from smaller firms. In contrast, volatility was notably heightened, as evidenced by a significant 15.37% spike in the VIX, often referred to as the fear gauge. This suggests that despite the upward movement in major indices, there is underlying uncertainty or anticipation of market fluctuations, possibly due to economic data releases or geopolitical tensions. European markets presented a mixed picture. The FTSE 100 in London declined by 0.76%, potentially impacted by concerns over domestic economic growth and currency fluctuations. Germany's DAX also registered a slight dip of 0.19%, reflecting ongoing investor caution amid broader European economic challenges. Asian markets showed varied performance. The Nikkei 225 in Japan fell by 0.68%, possibly due to profit-taking or concerns over export demand. The Hang Seng Index in Hong Kong experienced a marginal decline of 0.05%, indicating relative stability amidst regional economic headwinds. Conversely, the Shanghai Composite in China remained virtually flat with a negligible gain, highlighting subdued investor activity and cautious sentiment in the face of mixed economic signals. These movements across indices highlight the complex interplay of local and global economic factors influencing investor sentiment and market direction. In the current financial landscape, bond yields have shown a slight decline, reflecting a broader sentiment of cautious optimism among investors. The 10-year Treasury yield has edged down to 4.441%, marking a modest decrease of 0.31%. This movement suggests a potential increase in investor demand for long-term securities, possibly driven by a search for stability amidst volatile equity markets or geopolitical uncertainties. The dip in yields often indicates that investors are seeking the relative safety of government bonds, which traditionally serve as a safe haven in uncertain times. Similarly, the 3-month Treasury bill yield has also decreased, now standing at 4.237%, down by approximately 0.49%. This short-term yield movement can be indicative of expectations around Federal Reserve monetary policy. A decrease in short-term yields often signals that investors anticipate cuts in interest rates, or at least a pause in rate hikes, as the central bank attempts to balance inflation control with economic growth. The 30-year Treasury yield has experienced a reduction as well, now at 4.899%, representing a 0.39% decline. This drop in long-term yields could suggest that investors are adjusting their outlook on long-term economic growth and inflation prospects. A lower yield on long-term treasuries can reflect confidence in the central bank's ability to manage inflation over the long haul, or conversely, concerns about potential economic slowdowns that would keep inflation subdued. Overall, the declining trend in bond yields across various maturities underscores a mixed sentiment in the market. While the declines could reflect confidence in future economic stability, they may also signal caution about growth prospects. Investors will be closely watching upcoming economic data releases and central bank communications to gauge future monetary policy directions and adjust their bond market strategies accordingly. In a dynamic trading session, the currency markets exhibited notable movements, with the US dollar index showing a decline. The index, which tracks the greenback against a basket of 6 major currencies, fell by approximately 0.92%. This depreciation indicates a weakening of the dollar, potentially driven by market expectations surrounding US economic data or shifts in monetary policy sentiment. The euro strengthened significantly against the dollar, climbing by over 1.01%. This increase could be attributed to positive economic indicators from the Eurozone or speculative movements anticipating future policy adjustments by the European Central Bank. The euro's rise suggests growing confidence in the region's economic recovery or differing monetary policy outlooks compared to the US. Meanwhile, the Japanese yen experienced a decrease in value against the US dollar, dropping by around 0.55%. This decline could reflect Japan's ongoing challenges with economic growth and inflation, which may influence the Bank of Japan's continued commitment to its ultra-loose monetary policy stance. The yen's depreciation highlights the divergent paths in monetary policy between Japan and other major economies, particularly the US. The British pound also appreciated versus the dollar, rising by approximately 0.87%. This uptick may be driven by renewed optimism about the UK's economic performance or expectations of future rate hikes by the Bank of England. The pound's strength underscores the market's reaction to potential policy shifts and economic resilience post-Brexit. Overall, these fluctuations in currency values reflect a complex interplay of economic indicators, monetary policy expectations, and geopolitical developments. Traders and analysts will continue to monitor these currencies closely, as shifts in exchange rates can have significant implications for international trade, investment strategies, and economic policy decisions globally. In the commodities market, gold has experienced a notable uptick, climbing by 1.72% to reach 41.9. This increase suggests a strong investor interest in safe haven assets amid potential economic uncertainties or inflationary pressures. Gold's reputation as a hedge against volatility continues to bolster its appeal, and the current upward trend highlights its ongoing relevance in diversified portfolios. Silver also saw a rise, albeit at a more modest pace, with a 0.93% increase to 32.655. The movement in silver prices often correlates with industrial demand alongside its status as a precious metal. This dual role makes silver particularly sensitive to both economic growth indicators and shifts in investor sentiment towards safer assets. Crude oil markets, however, faced downward pressure. West Texas Intermediate crude fell by 1.33% to 61.66, while Brent crude decreased by 1.31% to 64.55. These declines may reflect concerns over global supply dynamics, potential economic slowdowns affecting demand, or geopolitical factors influencing market stability. The oil market remains highly reactive to changes in production levels and consumption forecasts, and the current downtrend could signal a cautious outlook by traders. Natural gas prices saw a significant drop of 2.25%, falling to 3.259. This decrease could be attributed to seasonal variations in demand, particularly as milder weather reduces the need for heating. Additionally, fluctuations in supply from major producing regions can heavily influence natural gas pricing, often leading to volatility. Copper's price edged up by 0.60% to 4.621, reflecting its strong industrial demand, particularly from sectors like construction and electronics. As a key indicator of economic health, copper's performance often mirrors manufacturing activity, and its price movements can provide insights into broader economic trends. Overall, the commodity sector displays a mixed landscape, with precious metals gaining ground while energy commodities face headwinds. Market participants will likely continue to monitor macroeconomic indicators and geopolitical developments closely, as these will play critical roles in shaping future price movements across these essential assets. Exchange-traded funds, ETFs, continue to be a crucial vehicle for investors looking to diversify their portfolios across various sectors. Recent performance data highlights both the opportunities and challenges present in the current market environment. Notably, the healthcare sector ETF saw a significant increase of over 2%, indicating strong investor confidence in this sector's resilience and potential for growth. This uptick may be driven by ongoing innovations and a robust pipeline in pharmaceuticals and biotechnology, which often attract long-term investment flows. Conversely, the energy sector faced a slight decline, hinting at potential volatility in oil and gas markets. This sector's performance is often closely tied to global economic conditions and geopolitical factors, which can lead to fluctuations in investor sentiment. The technology sector, with only a modest gain, suggests a mixed outlook as investors weigh the sector's high valuations against the backdrop of potential regulatory challenges and shifts in consumer demand. The financial sector. ETF's moderate gain reflects a stable yet cautious optimism. This may be attributed to a combination of factors, including interest rate environments, consumer spending patterns, and regulatory changes affecting banks and financial institutions. Investors appear to be positioning themselves strategically, balancing growth prospects with inherent risks. The notable performance of the innovation-focused ETF, which saw an impressive rise, indicates a renewed interest in disruptive technologies and forward-looking companies. This could be driven by investor appetite for high-growth opportunities despite the inherent volatility and risk associated with such investments. Overall, these ETFs provide a snapshot of sector-specific sentiment and market dynamics. They allow investors to tap into broader economic trends while also offering the liquidity and flexibility that are pivotal in today's fast-paced financial landscape. As always, investors should remain vigilant and consider both macroeconomic indicators and sector-specific conditions when making investment decisions. In a day characterized by a diverse array of movements across different sectors, healthcare and industrials emerged as key drivers of market activity. United Health Group led the charge with a remarkable 6.40% increase, reflecting strong investor confidence, potentially buoyed by robust earnings forecasts or strategic initiatives that promise growth. Similarly, CVS Health also impressed with a substantial 3.41% uptick, highlighting positive sentiment in the healthcare sector, possibly due to strategic expansions or improvements in their service offerings. Industrials saw significant gains, with Deere & Company surging by 2.94%. This could be attributed to favorable market conditions or optimistic projections regarding agricultural equipment demand. Tesla, a bellwether in the electric vehicle sector, also posted a notable gain of 2.09%, indicating continued investor enthusiasm around its market position and future prospects. In contrast, the energy sector faced downward pressure, with ExxonMobil and Chevron experiencing declines of 0.36% and 0.11% respectively. This trend may reflect broader concerns about fluctuating oil prices or a shift towards renewable energy investments. Notably, Schlumberger managed a slight gain, suggesting some resilience within the oil services segment. Technology giants presented a mixed picture. While Microsoft and Nvidia recorded modest gains of 0.25% and 0.42% respectively, Apple saw a slight decrease of 0.09%, possibly due to fluctuating market dynamics or profit-taking by investors. Consumer goods also reflected varying outcomes, with Procter & Gamble and Coca-Cola both achieving moderate gains. On the contrary, Starbucks faced a setback, dropping by 1.25%, which may imply challenges in the retail or consumer discretionary sectors. Overall, today's market movements underscore a complex interplay between sector-specific developments and broader economic indicators, with healthcare and industrials standing out as areas of investor focus and optimism. The technology sector, particularly those companies focused on artificial intelligence, continues to exhibit dynamic movements, reflecting both investor sentiment and the broader market's perception of tech innovation. Notably, the AI-centric company, showing a 3.20% increase, stands out with significant gains, suggesting strong market optimism about its future prospects in the rapidly evolving AI landscape. Electric vehicle giant Tesla, with a 2.09% rise, indicates sustained investor confidence, likely fueled by its continuous advancements in autonomous driving and battery technology. Meanwhile, AMD's 1.90% increase underscores the competitive nature of the semiconductor industry, where innovation and production capabilities remain critical. Apple's slight dip of 0.09% suggests a more cautious sentiment, possibly attributable to market saturation concerns or the competitive pressures it faces in the smartphone and services sectors. Conversely, Google's 1.36% rise reflects its robust position in digital advertising and cloud services, areas where it continues to expand aggressively. Despite a slight decline of 0.55%, Meta Platforms remains a key player in the social media and virtual reality sectors, though it faces regulatory challenges and evolving user preferences. Microsoft's modest gain of 0.25% showcases steady confidence in its enterprise software and cloud services, areas that have shown consistent revenue growth. ASML's 1.35% decline hints at potential challenges in the semiconductor equipment market, possibly due to global supply chain disruptions or geopolitical tensions impacting its operations. On the other hand, Intel's positive move of 0.51% suggests a market reassessment of its strategic initiatives and product roadmap. The diverse performance across these tech stocks highlights varying investor expectations and the sector's inherent volatility. Companies that continue to innovate and adapt to emerging technologies are likely to attract considerable attention and capital, shaping the future landscape of the technology and AI industries.